Hey guys, today I want to show you a way to make sizable returns on your investment with very limited downside through option selling and dynamic delta hedging to protect your downside risk. This is a comparatively low risk trading strategy that you can apply, and so returns can be, can be astronomical, but like it's reasonable to expect anything between maybe 30 to 50% again at a relatively calculated risk. I'm going to split this up into two different parts. First, we're going to speak about the options trading part, and then we are going to speak about hedging in the second part of this. So this trading strategy is a lot more complex than just investing into a single asset and hoping for the price to go up. But it's actually particularly profitable when the market is going sideways, which is actually happening more often than you would think. And it does happen when there is a lot of uncertainty in the market and so on. So it can be a great way to add, or it can be a great strategy to add to your portfolio of strategies, if you will. Now, let's dive into the options section. But before we go in, first of all, this isn't financial advice. This is a strategy that comes with considerable risk if not properly managed. If we talk about the agenda, then first of all, we're going to talk about how options work. And you can skip that part if you are already quite familiar with that. Then we're going to talk about what it means to actually go short on an option, meaning to sell an option. Then we're going to look at the strategy and how it is being employed. And then I'm going to take you through my actually current trade that I have live. And then the last part, we're going to actually make a trade together. So if you actually want to get your feet wet, then you can just use my referral link. Then you get a discount. I get like a small commission from that. If you're active, I think. But of course, you can also just sign up through the Deribit website or any options trading website, really up to you. Now, let's dive in. You might be familiar with them already to some degree, but I know that many people actually are not. We're going to have to talk about a few basic terms that you're going to run into eventually, and that are also important for this. Now, what you might know already is that options are a derivative, so they're not the actual asset, but they're derived. They derive their value from a certain relationship to this particular asset. Okay, so the first terms that you might be familiar with are call and put, which basically just means that you can either, or that it's about buying an asset or selling it. Yeah, and it really depends on what side you're taking, but we're going to get into that in just a moment. You might also know that you can go long and short. Long means that you are buying a call or a put option, and shorting means that you're doing the opposite, right? So you're selling this into the market. Another term that you need to know about is the strike price. So strike price simply means that this is what you agree upon in the contract, that for what price you're actually transacting the particular underlying, right? So let's say we take Ethereum, and Ethereum is currently at 2000, and you buy an option that lets you buy Ethereum at 2200. Then this 2200 is the strike price. The next thing that we need to also keep in mind is that an option can be in or out of the money. So in the money means, if we go back to this example that I was talking about, if the current price of Ethereum is actually above 2200, then it means that it's in the money, right? So there is intrinsic value to this option because you can buy it for cheaper than if you go to the spot market. Yeah? And out of the money simply means the opposite. It means that the price of your asset of Ethereum is below 2200. And this is simply the term that is being used for this. And that's also important for the strategy that we're going to be using. Now, another term is called the premium, and the premium is essentially the price that is being paid by the buyer to the seller of this option, right? So, again, to use the terminology that we had before, long pays short, right? And if you are the buyer of an option, then you're purchasing the right to do a certain thing, and vice versa. Okay. Now, another thing that we also need to be aware of is that there are different factors that impact the price of an option, right? So first of all, it's the question whether like this intrinsic value comes from the fact whether your option is in or out of the money, right? Which we've explained before. But there are two other concepts that actually have to have a huge impact on the pricing, and namely there's volatility in combination with time, right? So you can think of this as the more volatile a certain asset is, the more likely it is that it's actually gonna reach this particular price point, right? So the strike price is actually reached or exceeded, or you know, the reverse if it's a put option. And for that risk, you're paying a premium, right? Or for this opportunity, whatever, right? Now, the second factor I was talking about has to do with time, right? So volatility for one day obviously has a much lesser impact, or can ever have a much lesser impact than if you have an option that is only due in a month or so, right? Because with the same amount of volatility, obviously there is a lot longer time for this price to be reached, right? And also this is why this is essentially factored into the price. You can really go deep into the subject, and you've probably heard of the Black Scholes pricing model, or maybe you have. So this is largely what all these pricing models are based upon. But this is maybe a little bit too much right now to get into, and but yeah, definitely interesting to check out. Now, I don't know if it's a fun fact, but one thing that is to me is quite interesting to me is that despite the high volatility of crypto in comparison to other asset classes, which drives up the price of your options, it's actually very unlikely that you're getting wild swings of like 50% or so on at least on the major tokens in a relatively short amount of time, right? So, I mean, it has happened, I think, that you had a price increase of 50% or so, maybe over a few months, but if this happens, then it's very unlikely that this repeats like 20 times in a row, right? So what this gives you is, again, a very high level of volatility in comparison to other asset classes, which increases the price for the options. But if you average this out over a longer time horizon, then you can act, and if you make multiple bets along this timeline, if you don't basically kick yourself out of the market on the first opportunity, then you can actually, with the strategy that we're going to talk about, we're going to actually be on the benefiting side of this quite a bit. Okay, so that's the quick and dirty about options. Now let's talk about going short. So you might be familiar with the principle of going long a lot more. So this simply means that you're buying the right to either sell or buy a certain asset, right? Put or call. Now, what you might also have noticed, if you've ever tried that, is that over time, the value of your option is actually going down, right? Especially if all other things being equal, right? So if there is no change in the price, then you will take a loss on this time factor, right? So this is something, again, that we can use to our advantage when we're shorting, right? So when we're shorting, it means that we basically get the premium of the option upfront against our promise to either buy or sell the underlying asset if the option gets into the money, right? And so now the next part that we want to talk about is the actual strategy, right? So I think I said in the beginning that what we're doing here is called a strangle. And in this strategy, we're selling options actually on both sides that are relatively far out of the money. And relative is a relative term, right? So you can choose whatever distance you want to have. So I was using the example of, current price of Ethereum being, I think, at 2000. And then, so what you could do is essentially sell a call option at 2200, and you could sell a put option at, say, 1800, right? And I think I've even used similar numbers in the trade that we're going to be looking at. Now, the basic idea behind this strategy is that the price of the underlying asset will actually end up within this particular price range that you're setting. This means that these options will never be exercised, and all you get is the premium for this option, right? If this doesn't happen, so if you're basically, like, if the price is moving too much in one direction, then you are hedging that side, and that's what we're going to be speaking about in the second video for this. Now, one thing is super important to just keep in mind. Of course, you can have a really strong conviction that the price of your asset will rather move in one direction or the other, right? Now, you could be tempted to say, well, I'm basically taking a little bit more risk on one or the other side. But this isn't the idea behind the strategy, okay? So, of course, you can still choose to slightly favor one over the other, but this then exposes you to market risk, and this is actually what we don't want in this, okay? So we actually want to assume that the price is going to fluctuate between these two boundaries, and we're happy with basically taking the profit out of this, yeah, in order to not be exposed to the market risk. All right, now for this next section, this is actually going to be like we actually have to bear with this slightly more complex view here, and I know that this is a lot to handle at first, but trust me, if you spend a little bit of time on this, you will actually figure out like how you can actually how to make your way around. As I said in the beginning, this isn't the easiest strategy on earth, but it's manageable if you put some time in. Now, what we have here is I'm just going into the daily option here, just because it's I don't want to overthink like what position I want to take and so on, and I don't think that there's going to be a wild swing overnight, so we can hopefully see the option get executed. So what we can do is essentially look at where we are right now. So we are at 1876, right? And so what we want is like a fair distance between that price and whatever position we are taking. Okay. So what you see here on the left-hand side is are the call options. What you see here are the put options, and in here you have the different strike prices. Okay. Now, what we're going to do is, so let's just take the 2000 or so strike price, yeah, and so what this would basically mean is the price would have to move by 124 overnight, I think until next morning in like a few hours or so, for this option to actually go into the money. Okay, and I'm assuming that this is quite unlikely. So what I can do is basically go into this position. Okay, so what I'm going to do here is I'm just going to do a quantity of 1, and I'm going to set a limit price of, well, what should we do? So usually I try to actually go to the on the ask. But I kind of want to make sure that this position maybe executes relatively fast, so we can actually go into the, well, let's just go for the bid, because it should actually execute right away. And then all we need to do is hit sell, and that's it, right? So confirmation order filled. Oh, it's been filled already. Perfect. So now we also have to go in the opposite side, right? So again, we're at 1875. So let's just show, what do we pick? Maybe this, okay? So here we're doing the same, right? So again, a quantity of 1, limit price of 0.003, and then like this order should execute actually right away. So let's see if this works. And yes, so we're live, okay? Now, let's actually look at our positions, yeah? So I think we already took a quick look at this earlier. And basically what you see here is, as I said in the beginning, I think, well, the P&L is basically negative right away, okay? And that's because we're paying fees, yeah? So, I mean, it's okay if this trade isn't getting any profitable, but like in essence, that is kind of the starting point that you have. But now I have these 2 contracts, right? And I have my expiration date. I have put or call. I have my sizes, and so on and so forth, right? And so what should happen overnight is that we're actually running into a situation where these are turning positive. Okay, so of course there's not going to be a huge gain, but I mean it's still like reasonably high, right? So like just from these positions, I'm gonna make like I don't know, $11 or so, and that's not too bad. And of course, you can infinitely scale this up, right? So you can easily place like 50 ETH or something on both sides. But of course, you need to have like some collateral, right, in your account. And for this test account, I don't have so much in here. And this is also why this thing is red, right? So I'm not too worried about that. It's okay. But yeah, that's like technically this is, as I said, like pretty much unlimited what you can do here. So we're now about 12 hours in, and this is a situation that I think is very interesting to explore. So if you recall, this was the position that we've opened together, and it has both have a size of -1, meaning that we're short on both ends, and we have received the premium up front. Okay. Now the price has actually moved on. It has gone up a little bit, and now we're actually nearing this 2000 mark. Okay, so we're at 1940 or so, and we have a call option. We've sold a call option for 2000. Okay, so what now is happening, this option here on the market is actually trending a lot lower, sorry, a lot higher, because it has a lot more intrinsic value. And this is why this position here is negative. Okay, so what this just means is if you were to purchase this option back on the market in order to basically close this position, you would now need to pay a slightly higher price than you than you have received in the beginning. Okay, and here of course we have the complete opposite, right? So this is the put option, which is basically worth like has an ROI of almost 100%. And that is because the price has moved away from this this strike price here. Okay, so this is like you have a few different options that you could, or a few alternatives how you could deal with this situation now. I actually purposefully didn't hedge any of this, didn't set up any automated hedging mechanism. Because, and I'm actually glad that we're having this situation, because this is basically the situation that you want to avoid, right? So you don't want to be in a situation where your net position is, well, I mean, it's actually still positive, right? So we're like 11 cents on the dollar positive. But this is now a scenario, if this were to continue, then this is unlimited downside. Okay, and this might get you liquidated, or you know, basically eat into your equity, and this is what you don't want, right? So we're not going to be dealing with the hedge right now. I just wanted to show you this position because I think it's quite interesting. And actually, I'm going to leave these positions open until it gets too crazy, just to show you how this is going to play out in the end, right? But keep in mind, this is not what I would do in a normal, like for a normal trade, right? For my main portfolio, I would never just let it slide like this. But I think it's an interesting case, and I'm just gonna go in if things are getting a little bit too wild. But I have sufficient positions on other ends anyway, so that doesn't really matter. Now, the other thing that is also interesting to see, and this development has been going on since yesterday already. So here again, the intrinsic option value has increased, right? I think yesterday we were in the 80s or so, like low 80s for both. And now this has moved on by half a day, so this has gone up quite a bit. And the last thing I wanted to point out is as I said, I think like not even 12 hours ago or so, we went into this trade and we're already at a return on investment of 93. Okay, so just to make it very clear, it doesn't get much better than that, right? So the maximum return on investment that you're going to see here ever is 100. Yes, so this is basically done. So we're now 24 minutes before settlement or till settlement. And the nice thing is everything ended up working out as let's say hoped, right? So I'm not going to say that I knew this was going to happen, but there was a good chance. And in just a second, I'm gonna show you a screenshot for what was basically going on there. Let's actually do it right now. But before we do this, so what you see here, these are the two positions that we had, and this is my P&L, right? So this is just basically the fact that there is no mark price, right, or like no middle price for these options, and I have collected these premiums up front. Okay, so what happened here was like what's definitely going to happen, right? Unless Ethereum is dropping by what is it, like more than 100, right? Or like 100, then this would actually go negative, right? Or if it rises above 2000, then this would go negative. But yeah, it's kind of unlikely, right? So 23 minutes, 100%, 100 points moving, or $100 moving, that would be extraordinary. So what happened here, just to round this out, is I have given security for basically a day to somebody who wanted to have security, right? So I don't know what their motivations are, but somebody has purchased the peace of mind to be able to sell or buy their token, depending on which site they took. And for that risk that I've assumed, right? So could have gone negative, and it looked really, really dark in between. For that risk, I asked for a premium based on whatever the market rate is. Yeah, so this is just a principle that we've had here, and this is fair and square. Now, let's actually take a look at what has happened just in terms of the you remember that like things were basically going negative, I think a few hours ago. So let's actually look at perpetuals, which is essentially like it looks very similar to the actual movement. And this was the spike here that was giving me a little bit of a hard time sleeping, or getting through the day, right? Or, I mean, with that position, like, wouldn't have been a big deal, but still, like, this could have gone on like this, right? And then it would have ended up somewhere, I don't know, like 2200 or so today. And then this trade, or at least one side of the trade, would have been negative, right? So negative return, meaning that I would have to pay more than I would ever get out of it. And then actually a few hours ago, so when there was still some time value left in this option, it was actually hovering around this level, and my price was sitting at, I think, 750. So it was getting awfully close, right? And there was a good chance that, this could have basically fallen through the floor, and then the other side would have been positive. Okay, so of course these swings here, like this isn't totally unusual, um, but still, like what I tend to trust in, that there is going to be some mean reversion, right? So when it hit this point, I knew, well, some people are going to get their feet wet, and so then it's gonna come down to some level again, right? And I didn't expect it to just fly. There wasn't anything fundamental that would have supported this, and so yeah, it was like some kind of blip. I don't even know what it's caused it. I didn't check anything, but yeah, that was it. So the downward correction, though, this is a lot more. This is a lot more typical, I would say, right? Like it's actually a pretty steep drop here. But like it has somehow gradually climbed up again, because this was maybe a little bit too extreme again, right? And you can see like this rough trend line, or actually, like if you zoom out a little bit, like we're in downward trend, right? Just looking at this. So again, if you have mean reversion, then this is kind of what you like. This general motion is kind of what you would expect, right? So this is kind of like unfounded, at least on this time scale. Now, is all of this for certain that I've just interpreted into these lovely candles? No, of course not. And this is the reason why we are going into an hedge, right? So this is going to be the subject of the second part of this tutorial. And because to be honest, like even though it's not a it's not a lot that was at stake, I don't like to have positions that are minus 120% or more, right? So it's just not it's not just not what I want. So that's when hedges come into play, right? And again, this is it's not a light topic. Okay, so my internet connection is breaking right now, but it's not a light topic, but still, it's definitely something worthwhile. And I'm gonna show you another scenario in which I would use this, and at what point, and so on and so forth. But yeah, I just want to close out the session on the options. So I hope you found this interesting. Yeah, if you want to play around yourself, again, I think I said it a few times already. You can actually get a nice discount, or not, if you so choose. Yeah, but handle with care, right? So you've seen it. That's why I also started a recording in between, because I wanted you to see that shit can hit the fan like very, very fast, right? And so this is always something to look out for.